More analysis and some of the issues of the day from Zurich. We're joined by David Costa, Dean of Robert Kennedy College. Thanks for coming along, David. We were talking about Greece a moment ago with an investment firm who believe, as you may or may not have heard, that there are plenty of opportunities in Greece and valuations are looking pretty good. But they are in a position where they are having to commit to more cuts. There's still wrangling over the timetable for getting debt to GDP ratio under control. What's your position on how austere Greece needs to be to please its creditors and get growth back on track at the same time?
Well, I think certainly has demonstrated that they have made some steps ahead. But at the same time, I'm not convinced that austerity is really working, because what austerity has done so far, so Greece, if nothing else, is to accelerate the pace of recession. For that reason, I pretty much understand and I agree with what the IMF position, which just came out today, which is pretty much what Greece needs at this stage, more than just more time, which is certainly helpful, is really a forgiveness of some of their public debt. And that will be ultimately what Greece needs. If not maybe this year, it will be next year. But I don't see otherwise our plan, which forecasts this possible reduction by 2020, be sustainable on this period.
OK. So how should investors be positioning themselves, do you think, in a climate where we do have the risk that countries like Greece are going to have to push ahead with what you would consider to be too much austerity in order to please the authorities?
Well, austerity by itself will not solve the problems. It is certainly something needed to reduce the debt, but at that stage, you want to really find a solution to bigger problems right now, like unemployment, which is rising to a very unprecedented level, both in Greece but other bigger European economies like Spain. So I think investors at this stage will have to be a bit conservative and expect more monetary intervention or some sort of money printing intervention, is not from the ECB, from other European governments, because there is no really other way out of this in the short term. So I will be a bit more conservative at this stage and try to allocate more to real assets like gold, which will protect in the case of more money printing coming, not just from Europe, but also from the United States.
What is the strategy for gold, though? Because gold has been pretty much range-bound. Only within just the past couple of months, we started to see some upticks. Do you think central bank strategy could change? How should investors start allotting their cash into gold if they are getting it at these levels?
Well, I think one point is, for example, that the total reserves of China in gold are only 2%, which if compared to US, which is over 70%, is pretty much very, very low. And so we could see here a potential increase. But also, this year we have seen other central banks from South Korea to Brazil and Russia increasing their gold allocation. So in this environment where other buyers creating demand henceforth are central bankers, I would like to be part of it and certainly increase my allocation to gold, but not just gold will protect investors in this environment, also more conservative stocks like consumer staples, food and beverage, which pay a good dividend, and particularly companies which maybe even from Europe, but don't have a business entirely in Europe, but are very much diversified on a global basis. But in terms of gold, I would see possibly gold going easily at the 1,900 range toward the beginning of next year or by next year.
Okay, so gold could certainly move up much higher to 1,800 and beyond. But in terms of some of the dividend stocks and consumer staples that you highlight, hasn't that sort of been part of the strategy all year long?
Yes, it has been, but I would pretty much stick to what works, because there are so many uncertainties. And we have seen even now the outcome is not certain about Greece, and we don't know whether at some point there will be a disagreement in Europe and there will be sort of drawing a line and say we're not providing more help. And at that point, we might have a default, and that certainly will impact across the sector. So I would like to be conservative at this stage, because I don't see really a concrete solution more than all those deferring and continuous deferring, asking for more time. But the reality is, for some European economy, the debt burden is simply unsustainable. And even in 8 years, I don't think the governments will be able to endure these years and years of austerity without facing electors and really an upweight and a change in the strategy in terms of really what people want. And the discontent is so high in many European countries which are in difficulties nowadays that I don't see really how they could endure another 8 years or 7 years of tough austerity with a low or no growth environment.
Yeah, okay, well noted there. It's certainly a big toss-up. Our earlier guest, George, was saying he thinks Greece is at bottom, but whether this is the bottom or there is further to go, that is the key question. Good to see you, David. Have a fantastic day where you are in Zurich. David Costa from Robert Kennedy College. And remember, we have quite a bit of downside from China as well. A lot of concerns about the slow pace of growth in China, not to mention a critical leadership change on the horizon. Deirdre Wong Morris has a quick update on the markets.